You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast. And before we begin, I want to remind you that there is a website associated with this podcast called wealthformula.com. Lots of resources there to check out, including an opportunity to join our accredited investor club. We have been very active in that group as of late. Lots of opportunities, particularly distressed real estate, which I do think there is a window of opportunity here before a distressed market turns into one with significant liquidity and ultimately froth. So I don't ignore it at your own risk, but if you are an accredited investor and you at least want to see what's going on in there and get onboarded, go to wealthformula.com and sign up for our accredited investor club. Now, as for today, we are diving into a topic that it's surely to ruffle some feathers. It is a controversial one, particularly if you are a fan of Austrian Economics. But I've kind of gone sort of full circle on this. When I first started my podcast, I kind of spoke like an Austrian economics advocate myself, and then I kind of grew up. Look, I get it. Austrian economists have an appealing story. It's neat, it's clean, you save money, you balance budgets, and the free market solves everything. You know, it's comforting, it's nostalgic. It's like your, grandparents telling you what it was like in the old days. But while it's simple and neat, it just doesn't reflect the reality we live in today. I mean, we've had multiple examples of that. In 2008, Lehman Brothers collapsed and the markets were in free fall. It felt like the entire financial system was about to implode. Now, according to Austrian Economics, we should have just let the whole thing crash and burn. They argued that the economic downturns, even ones this severe, are necessary to cleanse the system and allow inefficient businesses to fail and make way for more robust ones. And in some regards, they absolutely have a point. There's no question about it. I am not an advocate for letting, lousy businesses who run inefficiently continue. But the Austrian economists argue that the economy should really just function like a forest fire, right? Clearing out the old and dead so the new can emerge. But the reality is, when you're talking about something like 2008, that fire, it was going to go to every corner of the world economy and leave nothing but ashes. Here's the thing. In 2008, the world didn't allow the fire to spread. The central banks, as much as we hate them, like the Federal Reserve, and we always, talk ill of them, they stepped in. And, quantitative easing, zero interest rates, massive injections of liquidity. Sure, we're paying for it now, but I mean, it certainly saved the day back then. Essentially they flooded the economy with money to stop bleeding. And if you ask what the Austrian Economist would have done in that situation, it'd say, well, you should have just used the laws of nature and everything would have fixed itself. But the reality is, what was done prevented a Great Depression, and we're still all here today not having gone through that because of unnatural interventions. And again, if you look not even as long ago as 2008, I mean, everybody at this point who probably is listening to this particular program was affected by the COVID-19 pandemic. Can you imagine no intervention there? Governments around the world shut down economies, businesses shuttered, millions of people were suddenly out of work, right? And again, those central banks that we generally don't have great feelings about, they unleashed trillions of dollars in a stimulus to keep things afloat. The Trump administration also did by sending a bunch of checks out to people and kept people alive, But again, the Austrian economists would have said, it's a sin, a violation of the sacred tenets of the free markets. But what was the alternative, really, right? A global economic collapse, having people starve to death? I mean, there really wasn't anything, right? So don't get me wrong. Printing money and keeping interest rates low indefinitely isn't a free lunch. It comes with consequences like inflation, which we certainly have felt over the past 2 years, big time. But the point is, we live in a world where pure economic theories rarely align with reality. Why? Because the global economy is far too interconnected, too complex, and too fragile to really leave this so-called invisible hand out there without intervention. So sometimes we need to have a heavy hand to guide the way, unfortunately. And that's just the reality. We've seen it now twice in this decade with 2008 and also with COVID. That leaves the Austrian economists sort of in a situation where they are living in a world a little bit of a fairy tale. Believe me, I do believe we need to do a lot better when it comes to being fiscally responsible and not racking up huge amounts of debt. But the idea of the Austrian economics, that Austrian economics can solve the issues of our day, again, a little bit of a fairy tale. Anyway, now that I have ranted sufficiently on this topic, and I know I've sufficiently pissed off you followers of Peter Schiff, I might as well keep the thing going by interviewing Mr. Richard Duncan, who's an economist, and he is going to talk basically about a similar topic as it relates to what would happen if we kind of let the free markets do what they did right now at this time in history. Now, Richard feels pretty strongly about these topics, so I would say that this is probably less of an interview than a lecture from Richard, but it's one that you will surely enjoy, and we will have that right after these messages. Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is a frequent flyer on our program. Lucky for us, his name is Richard Duncan. He's an economist, and he is the author of The Money Revolution: How to Finance the Next American Century, and is also the editor of a fantastic newsletter called Macro Watch, which we'll talk a little bit more towards the end here. But Richard, welcome from Thailand.
Hi, Buck. Thanks for having me back on.
I should say you're in Thailand, not me. You're in Thailand. So yeah, it's good talking to you again. And I always follow your emails too. I'm on your email list, and I was just reading through what you had to say, and I was like, you know what, we haven't had Richard on in a while, and it's probably an interesting time to catch up. But what caught my eye was, you talk a lot about credit and creditism and all this, and I thought it would be a good time to sort of, just review a little bit, because in this podcast space, as you probably are quite aware, there's a heavy influence of what are called the Austrian economists. They're different from Keynesians and so on and so forth. And why don't we start with this, just for a purely educational purpose? How do you define the Austrian thought here?
Okay, well, so the Austrian economists, they're called Austrian economists because they were influenced greatly by mostly Austrian economists from Austria.
Well, that's a great name for him then.
In the 19th, who lived primarily in the 19th century. I think probably Ludwig von Mises is the most well-known in the United States. And he wrote a number of very famous books that now have been very widely accepted throughout, as you said, not only the podcast space, but I think throughout society in general. I think most people understand their reasoning and have been greatly influenced by it. And one of the most important parts of the Austrian school of economic thought is about credit. And they explain that credit growth ultimately leads to economic bubbles, and that economic bubbles always pop.
Right.
So that's straightforward and pretty easy to understand how that works. If credit's growing rapidly, then consumers can get more money so they can spend more and consume more, and that boosts the economy. And businesses can get more money so they can invest more and hire more people. And as long as the credit keeps flowing, this results in an upward spiral of growing economic prosperity and economic growth. But their point is the day always comes when credit can't grow any further.
Yeah.
And when that arrives, then everything goes into reverse and the bubble pops and there's a very severe recession and there's an extreme price to be paid for the preceding prosperity.
Well, there certainly
built on.
Yeah, there certainly has been those patterns of bubbles and pops. But on the other hand, I guess the question is, could we have possibly have grown economically this fast if we were purely in an Austrian paradigm.
Right. So that entire school of thought was really built around the most important premise of their argument is that gold was money. They lived in a world where gold was money, and all of the economic thought, not only by the Austrians, but the other schools of thought, more the traditional schools of economic thought, that was also the premise around which all of classical economic theory was built. Gold was money, and everything followed from that. But gold is no longer money. And this has resulted in what I described as a fundamental alteration of our economic system. I sum it up like this. I believe that capitalism evolved into what I call creditism after dollars ceased to be backed by gold in 1968. And that has changed the way our economic system works. Afterwards, credit absolutely exploded. For instance, in 1968, the total amount of credit extended in the United States amounted to just over a little more than $1 trillion. Last year, it was above $94 trillion. So that explosion of credit has made the US economy many times larger than it would have been otherwise. And for that matter, the global economy. The global economy would look nothing like it does today if we'd remained on a gold-backed monetary system.
Right.
So I understand the Austrian thinking that credit leads to economic booms and economic booms bust. But the point I would like to persuade or convince all of the people who believe this theory is as follows. The bubble that has grown since 1968 has become so enormous now that if we allow it to pop, then it's going to be severe enough to most probably bring about a collapse of our entire civilization. Just imagine if a $95 trillion credit bubble implodes, how severe that would be. Therefore, I think all of these people who buy into this Austrian thinking need to be aware that if the bubble pops, essentially we're all doomed. The banks would fail, you'd lose all your savings, the stock markets would crash, nothing would hold any value whatsoever. Unemployment would skyrocket even higher than it did during the Great Depression. US government revenues would collapse, so the government wouldn't be able to afford Medicare payments or Social Security payments. They wouldn't be able to finance the army. They couldn't pay for the military bases around the world. So there would be geopolitical chaos and essentially societal collapse. So that's what we get if we follow the Austrian school of economic thought in terms of their policy prescriptions. They more or less are telling us that we have sinned by no longer backing money with gold, and that therefore we must suffer damnation because of our egregious sins. But they seem to have the idea that this would be a relative, maybe sharp shock that would last a couple of years, and then would be back in some sort of laissez-faire Garden of Eden. Mm-hmm. What I'd like your listeners to know is that no, this would be much more like the fall of Rome. Mm-hmm. When Rome fell, there was a recovery, but it took 1,000 years. That's sort of what we're looking at if our credit bubble pops now, and there's no reason for us to allow it to pop. We have the means to keep this thing inflated and in fact growing, and use this new economic system to our advantage.
Yeah, the thing is that, when you look at U.S. politics right now, there is very few people, even the Republican Party used to be more, probably leaning more towards, less credit and trying to be fiscally more conservative. But I don't think there's really any party that really is in charge in the U.S. that really thinks about going back to the gold standard anymore. Do you? Or do you think that's there's really any real political will in that direction anyway?
Well, I think a lot of the people who believe in, who are big supporters of Bitcoin, essentially have that view. They want Bitcoin to essentially be the new gold, right? And their thinking is that because it can't expand, then it's going to have all the virtues that gold used to have. But I mean, let's just think through that. If suddenly we were on a Bitcoin standard and the United States had to pay for its imports with Bitcoin, then last year the US current account deficit was more than $900 billion. So it wouldn't take very many years before the US completely ran out of Bitcoin. In fact, it probably wouldn't take very many months before the US ran out of Bitcoin and wouldn't be able to buy one more thing from any other country, meaning that all the other countries who have prospered on the back of their trade surpluses with the US, those economies, first and foremost, China, would collapse. They would implode. And consequently, then they would buy far less US goods. And the entire global economy would shrivel up, causing it the worst depression in history. So the same logic applies if we went back to a pure gold standard. Within a few months, given our trade deficit, we would run out of gold and wouldn't be able to buy one more pair of tennis shoes from China, and their economy would collapse. So we are on a dollar standard, and people are very critical of this dollar standard without understanding that this dollar standard is the thing that provides global liquidity and that has brought about the growth that we've enjoyed for the last nearly 60 years. It's primarily responsible for the global economic growth we've enjoyed. And it's pulled hundreds of millions of people around the world out of poverty. China, for instance, I moved to Hong Kong in 1986 and started my career in finance then. At that time, China was a very, very poor developing country. Now it's the second most powerful economy in the world and may soon become the most powerful economy in the world if the United States isn't careful. So, and it grew because it has had an enormous trade surplus with the US. For instance, since 1968, the cumulative US current account deficit, more or less the trade deficit, has been $15 trillion. So that means the other countries in the world have had a cumulative trade surplus of $15 trillion that they wouldn't have had if we'd remained on a gold-backed monetary system. And that $15 trillion went into their banking systems and allowed credit to expand far more than that through the process of fractional reserve banking. And this is the thing that's been driving our global economy for nearly 6 decades. So yes, credit has, just like the Austrians taught, it has fueled an enormous economic boom that has grown and grown decade after decade after decade. And if this boom does now pop, then the game's up, and the global economy will crash.
So let's talk a little bit about what's going on in the economy today. So every time I talk to you, it seems like there's some sort of major shift going on. Now, the economy it seems like maybe it's slowing down a little bit. What do you see out there?
Well, Buck, so before we move on from this, let me just hit a few more important points. So when we stopped backing dollars with gold in 1968, this, as I mentioned, fundamentally altered the nature of how our economic system works. Obviously, first of all, after that, the Fed was free to create as much money as it pleased or as it dared. Up until then, it had to hold gold to back the money it created. So that changed. So for instance, the quantitative easing that we saw after 2008 and again in 2020, that would have been completely impossible if we'd remained on a gold-backed monetary system. Next, trade between countries had to balance when gold was money. I referred to this a little earlier. If we were on a gold-backed monetary system, the US couldn't have large trade deficits as it has had because it would have had to pay with gold. And within a year or so, it would have run out of all its gold and wouldn't have been able to buy anything else. So this US started running very large trade deficits by the mid-'80s that just became enormously large by 2006. And this year, it will once again be something like $1 trillion. And so by buying things from countries from buying goods from other countries with low-cost labor, this was very disinflationary. It brought the inflation rate down from 14, 15% in the early 1980s to very frequently quite close to zero, between 0 and 2% during most of this century. And that was a direct result of globalization and being able to buy $15 trillion worth of goods from other countries. So that's the second change that occurred. It ushered in globalization, and that was very disinflationary. Inflation came down, so interest rates came down. As interest rates came down, asset prices went up, and the economy boomed. So at the end of the first quarter, total wealth in the United States hit $161 trillion. That was up something like, how much? Up $44 trillion from the end of 2019. So that was a 37% increase just since the end of 2019. $44 trillion is enough to pay off the entire US national debt with $9 trillion left over. So all of that dynamic would not have been possible if we'd remained on gold. Finally, this new arrangement, this new economic environment that fiat money has ushered in has allowed the government to have much larger budget deficits than it would have done otherwise. Because in the past, when we had gold-backed money, we had more or less a closed domestic economy because we couldn't run trade deficits with other countries. So if the US government spent too much money and stimulated the economy too much, then we would have very quickly hit full employment and full industrial capacity utilization. And that would lead to a wage push inflation spiral, as we saw in the late 60s and early 70s. But once we had a global economy, then the global workforce was 24 times larger than the US workforce. And many of these people were earning up to 90% less than the Americans were. So this completely changed the economic environment in which we live. So now people talk about, things like the velocity of money and that, but what we don't talk about is, we're not talking about the same economy we talked about before. The velocity of money meant one thing when we had a closed domestic US economy. The velocity of money is a completely different idea when you have a global economy with a workforce that's 24 times bigger. It no longer has the same relevance or meaning. So that's the point. Our economic system has changed. It's now driven by credit growth. It must have credit growth. If credit doesn't grow, then the economy goes into recession. And if credit contracts, as it started to in 2008, then we would go into a depression. And that's the
so
thing that
you
is very
follow
for your listeners to understand.
Yeah, so you kind of follow the amount of credit as part of is sort of your barometer for what's happening with the economy as well, right? So what's going on right now? Are we seeing a little bit of contraction in credit just because interest rates are higher, or how's?
So the rule that was very persuasive for a long time was that if credit growth adjusted for inflation, in other words, total credit in the country, you can look at total credit as more or less the same thing as total debt. It's easier to forecast total debt than it is total credit. So what this means is the debt of all sectors of the economy, not just US government debt, but the debt of the government plus the households, plus the corporations, plus Fannie Mae and Freddie Mac, and the non-corporate businesses and state and local governments. That's essentially it. That's all the debt in the country. If that debt grew by less than 2% a year, adjusted for inflation, so take the debt growth minus the CPI number, if that grew by less than 2%, the US went into a recession. That happened every time between 1950 and 2009. That happened 9 times. Every time credit grew by less than 2%, adjusted for inflation, we had a recession. And the recession didn't end until we had another big surge of credit growth. Once we got to 2009, things started to change, however. Credit growth was either weak or below 2% when adjusted for inflation, or just barely above the 2% recession threshold most of the years since then. But we have not been in recession most of the years since then.
Yeah.
And what has changed has been quantitative easing. That's, 2000 into 2008, 2009 was when the Fed first started creating trillions and trillions of dollars. Between late 2008 and 2014, the Fed created $3.5 trillion, which took their total assets up from 900 billion to 4.5 trillion. And then when COVID hit, they did the same thing again and roughly doubled their total assets by another 4.5 trillion, taking the total up to $9 trillion a couple of years ago. It's since come down as a result of quantitative tightening. Quantitative tightening now has already destroyed $1.8 trillion from relative to the peak 2 years ago. So this quantitative easing became a very important new driver of economic growth and has supported the economy primarily by pushing up asset prices. As I mentioned earlier, the net worth of the American households has gone up $44 trillion just since the end of 2019. And that's allowed people to consume more, and that's allowed the economy to grow more than it would have otherwise done.
Well, maybe we shift to talking about what's going on today. It looks like the economy's slowing. What's your read on what's going on, obviously, and what do you think? Do you think the Fed acted a little bit too slowly, or what do you think's going on?
So the economy was remarkably strong. As you know, almost everyone, including me, expected a recession last year.
Right.
I expected a recession because credit growth was below the 2% recession threshold. But the economy kept growing. Even in the most recent quarter, the economy grew by 2.8%. So the markets are suddenly in a bit of a panic about the US economy becoming very weak and possibly already being in a recession. This panic was accelerated at the end of last week by the job numbers. Only 114,000 jobs were created, whereas a much larger number of job creations had been expected.
Right.
And the unemployment rate moved up from, I think, 4.1 to 4.3%. But overall, the economy, the data right now is not showing that the U.S. is in recession.
Right.
It's just a question of whether it's going to go into recession. Now, it seems like with interest rates so high, nearly 5.5% on the federal funds rate, that's why everyone thought the economy would go into recession last year.
Sure.
But as it turned out, that didn't affect most people who have mortgages because they just locked in their mortgages at 2% interest and were not affected by the higher rates. Now, then in 2020, 2021, everyone received very large stimulus checks, which allowed them to pay down their credit card debt. And since then, they've built up their credit card debt again and have kept spending. It looks like now credit card delinquencies are back above the level they were before COVID started. So this is indicating that the people, the middle class and the poor class, are beginning to run out of the ability to borrow and spend on their credit cards. So suddenly we're seeing a slowdown in corporate earnings being reported in this quarter by companies like Disneyland, for example. And other consumer-related businesses are reporting weaker earnings growth, suggesting that consumption is slowing down. So it does seem that the economy probably is going to slow, and it makes total sense to expect it to continue to slow if interest rates stay so high as they are.
Right.
So it is therefore quite likely that the Fed will, they've more or less signaled that they will cut in September by 25 basis points. It wouldn't be surprising if they cut by 50 basis points in September and now start to cut more rapidly, particularly if we continue to see any sort of economic weakness, because on top of all of that, the inflation has come back down. The inflation, CPI, spiked from, peaked at around 9% a couple of years ago, but now it's back down to 3% at the CPI level and heading down. If you
Right.
annualize recent months, there are strong reasons to expect the inflation to keep coming down.
Right.
And the Fed's favorite measure of inflation, the PCE price index, is is more like 2.5% and heading down as well. So we had a spike in inflation, but it did turn out to be transitory, or at least that's so it appears now. It seems like it was caused primarily by the global supply chain bottlenecks surrounding COVID and Russia's invasion of Ukraine, and also fueled in part, but a lesser part, by all the stimulus money that was handed out to the Americans, creating a great deal of demand at a time when everyone was locked down and supply was disrupted.
Right.
But now those factors have more or less been worked out and the inflation's low again.
Yeah.
So there's every reason to expect the Fed to cut interest rates, and probably aggressively, over the next 6 months.
What do you see? When you look at the situation that's happening right now, what's your sort of view on the U.S. economy over the next year?
I think the economy will slow, but it shouldn't slow. It's been growing above trend, so that wouldn't be surprising. It may go into. I wouldn't be surprised if it does go into recession next year. I don't see any reason that the bottom should completely fall out, and I don't see why we should experience any sort of replay of 2008, for instance. But there is good reason to see why it would temporarily go into recession again. I mean, recessions occur periodically. It's nothing to be shocked by. To see some slowdown after such an extended period of growth is something that should be expected. Now, I think the primary reason that we haven't had a recession thus far is because the government handed out so much stimulus money during 2020 and 2021, taking government debt up very sharply in just a few years. But that increase in government debt occurred primarily because the government was sending stimulus checks to the public, and the Fed was financing that government borrowing that paid for the stimulus checks by creating money and buying government bonds. So this was fiscal and monetary stimulus on an unprecedented scale at a time of peace. Now, this is something more like wartime stimulus. During World War II, of course, the government had enormous budget deficits. It spent huge amounts of money fighting the war, and the Fed helped finance that government spending by creating money. And after that, so much stimulus was applied during wartime because of the need to build weapons and fight the war. We had 2 decades of prosperity following that buildup in government debt and stimulus. So what we've been experiencing over the last couple of years is a result of the huge stimulus, fiscal and monetary, that we saw in 2020 and 2021. Now, how long that's going to persist is still uncertain. It surprised everyone last year, and the economy kept growing. I wouldn't be surprised if it continues to support the economy this year. I think one of the big questions about the economy going forward, and perhaps its greatest vulnerability, is the fact that asset prices are so inflated. That is the biggest and most bearish warning signal on my radar. I look at something called the wealth to income ratio. And what this is total household wealth, all the assets of the households minus their liabilities. So this is all their stocks, all their pensions, all their deposits, all their wealth, divided by disposable personal income. So it's wealth to income. And the data on this goes back to 1950, and the average for this wealth to income ratio since 1950 has been 550%. It jumped as high as 620. That was a record in 2000 during the NASDAQ bubble. And then it blew up and it went back to 550. Then the 2007 property bubble, it went up to a new record high of 680. And of course, that bubble popped and we went back to 550. Well, now it's practically off the charts. It's much higher than it's ever been before, almost 780%. The highest before this was 680. So this is a big worry. Every time this wealth to income show has moved higher in the past, then it pops and destroys a lot of wealth. And that wealth destruction would slow consumption and exacerbate any recession that would possibly occur, and could make it much more severe.
It's probably
So that's the biggest thing I'm worried about.
Right. That's probably why Warren Buffett sold half his Apple stock. Right, looking for the next correction here. So
right, and then of course this unwinding of the yen carry trade seems
right.
to be a very big part in the sell-off that we've seen over the last week around the world. The movements on Monday were really quite shocking. The Japanese stock market fell 12%. That was the biggest drop in Japan since 1987, during the October 87 crash. And that day, NVIDIA was down 15%, Bitcoin was down 15%, and all of the risk assets sold off.
Yeah.
So that does seem to be playing an important part in what's happening at the moment. And there, of course, the Japanese yen was weakening and weakening, and interest rates in Japan were zero. So investors, whoever they were, could borrow money in Japan at 0% interest. And when they had to pay it back, they would have to pay back less money because the yen was weakening. And then suddenly, the Bank of Japan raised interest rates, and the yen started strengthening. And so suddenly, instead of having to pay back less money, everyone who borrowed yen was beginning to have to pay back more money. And that made this whole yen carry trade unprofitable, and it started unwinding. I don't have data to tell you exactly how much money was borrowed in yen and invested, but the Financial Times this morning reported a couple of numbers. One was $500 billion and the other was $1 trillion, two different estimates by different institutions. So and it was a great deal of money. And a lot of that had occurred just within the last couple of years. So that being reversed was the trigger, I think, especially since the Bank of Japan indicated it would increase interest rates at a time when the Fed is indicating that it's going to reduce interest rates. So that's been a big problem. I think that's been the trigger this week.
Well, fascinating stuff. Richard, you have a newsletter. People are listening to you right now, and they are very interested, and they want to know, how do I learn more about sort of macroeconomics? And I think a very good source is your newsletter, which, kind of starts out for many ways. I've been a subscriber in the past, and starts out with a great introduction for people who don't know very much at all about macroeconomics. Do you want to talk a little bit about that?
Right. Thanks. So yes, MacroWatch is a video newsletter. Your listeners can find it at richardduncaneconomics.com. That's richardduncaneconomics.com. And every 2 weeks, I upload a new video, essentially me making a PowerPoint presentation about something important happening in the global economy and how that's likely to impact all the asset prices. And as they say, a picture tells 1,000 words. So with these charts, I think I can explain very clearly not only current events, but also explain the very important concept that the economy doesn't work the way it did in the past. MacroWatch explains the new forces driving the economy and the financial markets in our post-capitalist world, now driven by credit growth and greatly influenced by government policy and money creation, not only by the Fed, but by central banks all around the world. So I've been doing this now for almost 11 years and have made 100 hours of videos, which are available to subscribers in the archives. So I hope your listeners will go to richardduncaneconomics.com, take a look at the website, and if they'd like to subscribe, I'd like to offer them a 50% subscription discount. If they hit the subscribe now button, they'll be prompted to put a discount coupon code in. And if they use the coupon code formula, they can subscribe to MacroWatch at a 50% discount. And the price is very affordable.
Yeah, it's definitely worth it, I think, for people who are interested in learning a little bit about the economy. Richard's perspective is, I think, pretty unique, and it's a good way to kind of ground yourself on sort of what's going on a day-to-day basis in the world. So, Richard, thank you so much for being on Wealth Formula Podcast as always, and I'm sure we'll catch up in the near future.
Well, great, Buck. Good seeing you again, and thank you for having me back on. I look forward to the next time.
Welcome back to the show, everyone. Hope you enjoyed it. Before I forget, I do want to remind you that our friends Rod Zabriskie and Christian Allen of Wealth Formula Banking, those guys are having an event on Thursday of this week, and it is a free event. It's basically a summit. It's a wealth summit, and they've got a bunch of interesting talks that I think you might enjoy. So I've sent this email out already. I'll send it out again this week later if you haven't gotten it. Another reason, by the way, that you should be on my list if you are not, go to wealthformula.com to get on one of the lists. But that list, or that email, will give you a link basically for a free ticket to the summit. So make sure to check it out. That's it for me today on Wealth Formula Podcast. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.